Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. With this video, I'm going to take a deep dive into the many faces of valuation of Nvidia Corporation, one of the most exciting semiconductor companies on the planet. If you notice, the company has fallen since September 28th. The company's stock price has fallen from $281 all the way down to $157. It's up a little bit today. This is yesterday's close, which is a 44% drop in value or a 96.7% annualized negative rate of return. Now, looking at this graph at first glance, it would appear that Nvidia was also significantly overvalued during the period 2016 through 2018. However, as I pointed out in the written portion of this article, which includes this video, that there are many faces to valuation, and valuation is not only a very dynamic concept, it is also an evolving concept and relative to what is going on in the company, past, present, and future. So let's take a look at Nvidia from a standpoint of valuation over its history. Now, I'm going to start by taking the price off of the graph, and I'm going to use my scroll feature here, and I'm going to go back in time and look at the company from the period 1998 through 2013. I want you to notice earnings growth during this time was about 15%. If I put monthly closing stock prices on the graph, you'll see that there were periods of high valuation, but there was this constant reversion to the mean where this 15 PE ratio became a very relevant valuation reference for this company. And that continued during a time when the company's earnings growth rate was averaging about 16.9%, but it was also during a time when the company's earnings growth was very cyclical, we'll call it, periods of very fast growth, which justified this valuation. And I'm going to go ahead and give you a sneak peek at what I'm talking about. If I scroll back to this time frame here and look at Nvidia's earnings growth rate during this time frame, you can see that it was about almost 40% a year, and the valuation does not look that out of line. And then we had this drop in price, and then we saw the valuation fall. Nevertheless, when I look at Nvidia over the time frame 1999 through 2014, I see very, what I'll call, rational valuation references. We had earnings growth spurts where the company's stock price got very high, and then we had negative earnings growth where the price reconciled and came back and reverted to the mean. Here I'm using a PE ratio of about 16.9, once again illustrating the dynamic nature. Then we saw earnings growth accelerate dramatically in fiscal year 06, 07, and 08. We had growth of 189%, 33%, and 81%. And of course, the stock price responded, going from $4.84 a share up to $35 a share, averaging a 91% annualized rate of return. But then as we came into the recession, we then saw the stock price fall dramatically, where it fell almost 78% from $36 down to $8.07 with an annualized negative 69.7% rate of return. So the point is, valuation is very dynamic with this company. This company has been very cyclical and very dynamic. Now, as I move this along a little further, we start to see a period of time where earnings growth was averaging about 23%, and we're using a P equals growth rate earnings valuation reference here, and we can see that the company's stock actually was valued at around that 23 PE over this time frame, but then it began to get, pretty highly valued. But what was happening during this time frame, I'm going to bring this up a little closer here, is we started to see earnings growth rates accelerating into the 30% range. And then we had the highest period of earnings growth, which forecast to end with fiscal year 2019, which ends in January, where we currently have an estimate of 47% growth. But last year we had 61% growth and 83% growth. So from this point of view, Nvidia actually looks like it was undervalued, or it's currently undervalued. But then we're expecting a flat year, at least analysts are expecting a flat year in fiscal year 2020, and that shortens up the time frame a little bit and changes the earnings growth rate and the earnings dynamic once again. But we still have this high 39% growth rate. But as I push this forward and we start cutting out some of these high growth years, we now see Nvidia's earnings growth rate falling to what is expected to be around 20 to 21% a year, which now justifies the company's valuation falling to this level. So the point is that valuation is a very relative term. It's relative to what is going on in the company, past, present, and future. Now, looking at this historically, NVIDIA's stock price made total sense all during this period of time. There were peaks and valleys of earnings growth, spurts of growth followed by falling earnings growth, and the company's stock price clearly tracked that and reacted to that. But then this huge surge in stock price that occurred from, I'm going to pick the period June of 2015 to ultimately peaking in September of 2018, we had this, 14-fold increase in value, 126% annualized rate of return, until we've now had this recent precipitous drop in price on Nvidia. Now the question is, what's the valuation of Nvidia looking like today? And this is the real question. Well, looking at it from a historical point of view, as we just have been looking at, we can see that as their earnings growth rate dynamic changed, the company's valuation changed. Now here we've got a lot of analysts following this company. We've got 31 analysts reporting to S&P Capital IQ, forecasting this company to have a flat year of earnings coming up in fiscal year 2020. That'll end in January of 2020, by the way. And then followed by relative to some of these previous numbers we were looking at, a subdued earnings growth rate in 2021. So analysts are expecting a slowdown in the company's growth, and consequently this reaction is starting to make sense based on future expectations, because the market is theoretically discounting the future. This reasonable, or this past surge in stock price was reasonable, again, going back, looking at the company's operating growth rate during that period of time. This stock price really made sense because the company was growing at such a very high rate that the valuation was high. But there's another point I want to make. When you've got 60% growth rates like we're looking at here, or even 50% growth rates like we're looking at here, you have to understand and be cognizant of the fact that it's very, very difficult for a company to sustain that. So when you have high growth and high valuations, we had PEs here in the 40s and 45, 50 range during this time frame when earnings growth was averaging about 50%. It made sense for that period of time, but it was also very tenuous relative to the company's ability to go in the future. Now I'm going to go to the external links here with fast graphs, and I want to go into Yahoo Estimates here, and I'm going to look at Nvidia. As you can see, the stock is currently up almost 3% today. If I look at the consensus estimate for the next 5 years, and these I believe are analysts reporting to Reuters, they're looking at 15.56% earnings growth for Nvidia over the next 3 to 5 years. If I go to S&P, we have a different group of analysts here. These analysts are looking at the company growing at about 14.9%. Now the difference between 15.56 and 14.9 is really not that material. I can go in here to the custom calculator and I can put in the 15.56. Now on that basis, if it grows at that rate, in theory this would be about a 15 multiple company using standard formulas to value a company, which means your return out for the next 4 years or so would average less than 1%. If the company traded at more normal valuations like 20 PEs, which has been more its average, I'll show you that here in a moment, it could make 9%. But the point is, this earnings growth is part of why the stock price is reconciling, because the expectations are not for that high into the future. Now, if I go back to the actual consensus growth rate that the analysts are expecting for this company off of Standard & Poor's of 14.92%, I still get a similar, here I would get a loss. In other words, the 15.56 would give me a slight gain. Looking at this 21 multiple, I would have about a 7% rate of return. So let's evaluate normal PE ratios. If I go to the normal PE ratio forecasting calculator on fast graphs, I've got this drop-down window. The one thing that I can essentially glean from this is that historically this has been about a 22 to 25 multiple company. The lowest PE was the 6-year normal at 19. The highest was the more recent one, which caused the price fall of 42. So if I pick kind of a middle ground PE here of something like 22 and utilize this, then Nvidia, it looks like it's a decent valuation, but the future rate of return would still be less than 10% a year based on the fact that earnings growth is not expected to be that strong over the next year or two. If I go back to the 3 to 5 years and use that 22 or 21 multiple somewhere in here, then I've got a possible double-digit rate of return, annualized rate of return, 8.78 to maybe 10% rate of return. But the point is this: when you're looking at a stock and trying to determine valuation, you have to recognize that valuation is relative. It's relative to what the company's growth has been in the past, but it's also relative to what it's been doing recently. And then most important of all, it's relative to what's going to be happening in the future. As I said in the written portion, you can learn from the past, but you can only invest in the future. So in my view, I consider Nvidia fully valued today, if not moderately overvalued, based on lowered expectations for growth going forward. Even though the company has fallen as much as it has, I still don't consider it as yet a bargain. And as far as the growth or the spurt of performance that it had from 2015 through September of 2018, I actually consider that a reasonable justification based on what the company was generating in terms of operating growth over that time frame. So again, valuation is dynamic. It's not just about matter of just calculating a PE ratio or a price to operating earnings or price to growth. It's also about evaluating the company based on numerous other metrics that you can look at, which I don't have time to go into with this video. Anyway, I hope this gave you some perspective on how valuation is a dynamic and a relative concept. This has been Chuck Carnevale saying thanks for watching.